Okay, let's get going. Good morning, everybody. So busy day today because obviously we've got Andy McHattie on talking about what happened during September. And our guest this week is Richard Brown from Castlenau, which is an interesting trust. I think one we ought to get to know better. So bits of news first. I've put up four things. They're all quite short. You'd be pleased to hear. And then we'll get to Andrew. But we'll start with the Charter On-Site Energy. Normal kind of picture here where the share price falls off a cliff. But in this case, the NAV has been slipping and it's really disappointed investors. It's not very big, 115 million market cap. The discount, even after this jump, is still about 15%, and it yields about 7%, but that's maybe moot now. So what it said was, on the 3rd of October, it's going to sell its entire portfolio to Brookfield and Apollo for about 218 million pounds, 290 million pounds. That needs shareholder approval, obviously. So there's a meeting now scheduled for this on the 22nd of October. So really, we're really sort of motoring with this stuff. That deal should complete if it gets approved by early mid-November. Then shortly after that, there'll be another circular to approve the liquidation of the company. That will mean it gets delisted. I think so. Basically, the meeting will probably be end of November, in December, and delisting in December. But you won't get the cash until February when everything settles down. Nevertheless, that quite speedy in the scheme of things. In terms of the amounts, they're talking about ATP, which is an 11% discount to the last published NAV, 25% premium to the pre-announcement price. It's not too bad. It's not amazing, but it's not too bad. I would doubt we're going to get much of a counterbid here, if anything. So I think this is probably the situation as it finishes. Obviously, disappointed investors, and that's why people wanted it done. So fair enough. Talking about disparaging investors, here's key symptoms of a change. That is a 10-year chart, and you can see how bad it's done over 10 years. Really, very poor. The discount has been tracking in a bit over the last year and a bit. So I think partly that is stake building by some activists, one of which notably is Saba Capital. Again, it's not very big, so it's been that's not a huge stake that they've got monetary wise. The discount's gone into 6.5%. There doesn't seem to be enough wiggle room left in it now. We talked about this back on the 13th of September anyway, and nothing's really changed, but what they have announced here is that sort of the more detail. Again, there's a cash exit if you want it, but as a discount to the formula asset value, I don't see why anybody should take that, to be honest. It's much better to roll into the open-ended fund, which is the alternative, and then immediately hit the redeem button, and then you should get out at NAV. There's a wrinkle in all of this. So 4.3% of the portfolio, what they said is they're going to put the unlisteds into like a sort of side pocket thing. They'll liquidate them over time and then give you the cash back separately. And that depends, that's regardless of whether you go for cash now or roll into the other fund. So that will obviously take time to unwind, and that's a good reason why it's still a 6.5% discount. Residential Secure Income, another subscale trust, about £100 million, but one actually I quite liked. It's on a big discount, it's on a big yield, and it just really didn't get big enough. So it launched in 2017. It's a mixture of sort of independent living for retired people and shared ownership homes for people who can't afford to buy the house outright. They did have some local authority accommodation. That's all been sold now. And that was actually sold at premium to book value. And that would mean they could pay off their floating rate debt. So it's just a mix of the retirement living, which is the big chunk, and then shared ownership stuff. And you can see that down there. And these were quite attractive, really. So they're inflation-linked leases linked to RPI, which is obviously higher than CPI, with a cap, so 6% for the independent retirement flats and 5.5% for the shared ownership stuff. And that had a floor in it as well, in case we ever go back to deflation. That seems unlikely for the moment, but we never know. And there's a bit more information on the portfolio. So reasonable yields with a bit of leverage in there. So actually quite attractive leverage yields and very good kind of occupancy and rent collection stuff. So there's really nothing wrong with this at all. We're not talking about home REIT or triple. There's nothing wrong with this at all. But it's just too small. So investors seem to want their money back. So that's what's going to happen. It's going to be a managed wind down. I think you'll get a lot closer to NAV than the current share price is implying. So there might be some room there for that discount to narrow. But yeah, it's a small thing. You might want to play that. Triple point entry transition. I'm only mentioning this because obviously this is already management wind down, but it's this thing with these white greenhouses. So go all the way up to SQN. It financed these. It's never really worked for everybody. It's always been a sort of personally something wrong with it. So it sold the loans that it had against those, which it's a combined heat and power plant that supplies heat and I think carbon dioxide to these glass houses where they grow tomatoes. And it was supposed to get 17.5 million, most of it up front, and then some stage payments. And they've already basically had a default on the first of these three stage payments. And they're talking about a payment plan of P3P partners, who are the people they sold the loans to. I don't know what this says about P3P partners. Maybe they're struggling. They've got all sorts of interest in all sorts of pies. But obviously they'll be exposed probably to falling power prices. We'll have to wait and see where that's a thing. Maybe more news on that later on. But I think the interesting maybe thing for Tent shareholders is that if the money is available, they might get all of this money faster because of the default. And I think that's kind of what that comment is saying here about all amounts due under the promissory note. So actually, this might turn out to be good news for Tent if there's money available. We'll have to wait and see. So that's enough from me. I'm going to hand over to Andrew.
That's great. Thank you very much indeed, James. I'll just switch to my screen. What a lot of miserable news you gave us there. A lot of rotten tomatoes. So I'll see if I can provide something a little more optimistic about trusts that do have scale. So let's have a look at the movers. And there were some quite big ones actually this month. Clearly, those three at the top are quite exciting, and I'll talk about those. And a lot of corporate action took place and resulted in some quite good, strong share price gains. So we saw Chrysalis Investments starting its buyback program, partly with borrowed money, which is a curious precedent, not particularly one I'm keen to see followed. Balanced Commercial Property Trust received a takeover bid. Aberdeen Property Income sold its portfolio. Menharden Resource Efficiency instigated a strategic review. So there's quite a lot going on, and this is reflected in some quite interesting share price movements. But inevitably, the ones I'm going to talk about are those three at the top. So I'll come on to those. On the downside, again, one or two outstanding features. On the subject of curses hitting investment trusts, Ecofin US Renewables has had a similar kind of path, hasn't it? If you remember, it was hit by a tornado that knocked out its big operation in Texas and subsequently had further operational issues. That's going to wind down, but its NAV has come down. Digital 9 infrastructures on there again. Hydrogen One Capital Growth. Some of these trusts seem to appear on the list quite frequently. And on the subject of things that appear frequently, I will talk about Schiehallion Fund, which is probably the most regular participant on this list, and also two of the healthcare trusts, which fell by just over 6% over the month. So let me crack on and talk about China, which has had an utterly spectacular rally. And this is quite staggering, actually. And I think it's interesting just to consider how it came about as well as the actual result. Because, of course, in the UK here, we're waiting with bated breath for the budget to come on October 30th. It's all been diarised, it's in the calendar. We have seen a lot of discussion, a lot of the potential ideas I think that the Chancellor is juggling with have been floated in the media to see exactly what the market reaction is. So much of that is signalled in advance. In China, things just happen differently, don't they? And there's been this staggering stimulus package that came from nowhere and I think was really completely unexpected, which is why it's had such a big market impact. But this is what totalitarian government can do. I mean, it can deliver changes very rapidly without this need for public discussion or for any form of consensus. And that can be good and bad, but it certainly creates this extra volatility in the market. And in this case, the stimulus package that has been proposed is enormous. It's about £100 billion to begin with, which is really that's the monetary easing part. And I think there's some fiscal easing to come with it. And this is because the economy was clearly not meeting its growth targets. And I think for that reason, China was massively out of favor with investors. Nobody I was talking to was ever proposing any Chinese exposure. They were really talking it down, saying, well, we don't have very much exposure to China. Isn't that a good thing? And so the markets were completely out of favor, which means that they've soared in response to this, really on a scale which was completely unexpected. And this has meant that all three of the specialist Chinese trusts have moved very sharply higher. I'll show you that on the chart now. And it really is dramatic. This is a 6-month chart, which I felt was the best way of presenting this. And you can see that for most of the last 6 months, these trusts have been out of favor, slowly sinking in value, and really nobody's wanted to touch them. And so we've had this very, very sharp rally. And in fact, I created this chart yesterday. Had I updated it this morning, those lines would have gone even further north because the rally is still continuing. So it's been a very dramatic reversal of this period of weakness. And of course, the question everybody wants to answer is whether it's going to be sustained, whether this market rally is going to just fall back again, or whether it's going to move on further. And I think that's incredibly difficult to gauge because you're dealing here, as I mentioned, with authorities that have absolute power. They can decide exactly what they're doing, and they're not necessarily going to flag that to the market. So it's pretty difficult to anticipate exactly what's going to happen next. A lot of managers are now going to address this, of course, and there's quite a lot of briefings set for the coming couple of weeks, which I'll tune into to get some better idea of what they think. But I think it's very difficult to gauge whether those three Chinese trusts are going to move higher or lower. I think the thing I can probably indicate is that they will be on the list of movers next month. I just don't know which side of the the list they'll be on. So I think perhaps a sensible approach is to look beyond those three trusts and to consider other trusts that could be beneficiaries of a more positive environment in China and some re-energization of the economy there. Certainly, I think beneficiaries of global trade could well prosper from this. I think perhaps the two shipping trusts are relevant there. And I think as well the rest of Asia, because clearly the health of the Chinese economy has a big knock-on effect throughout the rest of Asia. And my impression so far is that the rest of Asia has not rallied that much. And so I think there could be opportunities available in other more general Asian trusts. I've listed some there, and I think the first one, the first ticker code there, DGN, I mean, that's Aberdeen Asia Dragon Trust. I think that's particularly interesting because, of course, it's still waiting for the result of its strategic review there, which has been going on for quite some time. So maybe you've got a double-barreled opportunity there. I think as well, if we're thinking about this subject more broadly, it's worth reminding ourselves that China was really quite hated just a couple of weeks ago, and now it's had this enormous rally. And that's a handy reminder, actually, that out of favor sectors can indeed come back into favor quite rapidly. And it made me think, actually, about the renewable sector, which has really fallen well out of favor. Obviously, James was just talking about trusts winding up there because they're not seeing sufficient demand and because their ratings are too low for them to raise more capital. I was talking to one of the major managers in the sector this week, and he reckons there's going to be quite a lot of consolidation to come in this investment trust sector, and that, of course, could re-energize it. And there's certainly, I think, an impression now that deals are getting done. So that was interesting with Atrato On-Site Energy there selling its portfolio. I think we are seeing these deals being done now. We might see further consolidation, and I think as well, the Bank of England is indicating that it might be a bit more aggressive on interest rate cuts in the coming months. And if that does indeed transpire, then I think, again, that could be very beneficial for that sector. So that's a slight side issue, but I think it's interesting. And just a reminder that actually we shouldn't have views that are too hard and fast on individual sectors. So I'll just move on to the Schiehallion fund, which I think appears on this list all the time. It is very volatile, and really on a very frequent basis, it's either rising or falling by double-digit percentage terms. So I think it's just worth reminding ourselves of what this trust is about. I mean, it's clearly a volatile share price on a big discount now of 33.6%. But this is a Baillie Gifford managed trust that is a private. It buys privately held companies, normally late stage companies that might be gearing up for public markets or for sale. And you can see on the right hand side there the list of top 10 holdings. The one at the top is the one that normally attracts all of the attention. Space Exploration Technologies, that's the Elon Musk company, and that's quite a big chunky holding here, along with ByteDance, which owns TikTok. And these are companies that are clearly developing rapidly, have a great deal of latent value in there. If they were to IPO or to be sold, then they could raise significant amount of money for this trust. It's not surprising it's volatile. I mean, it does revalue its assets frequently, but the volatility here isn't really coming from the NAV. It's just coming from share trading. And my feeling is, having looked at the volume figures, which are not very high here, I think it's quite an illiquid trust where many of the holders are actually quite solid holders. They're not trading it. And it means the actual liquid float is not that large, although it is actually quite a big trust itself. And I think whilst that current discount does look very attractive, actually it's not out of line with other direct private equity investment trusts or trusts like Chrysalis Investments that are in growth capital. So I'm not sure it's an opportunity, but it's certainly interesting. And we have seen this enormous volatility over time. The red or orange line at the top there is the NAV, which hasn't moved very much over the last year. Well, this is the year to date. So that's not what's driving the volatility in the share price, which is the blue line here. And that really is very volatile. I mean, it's moved from about 60 US cents at the bottom here to $1 at the top. So it's a big range. It's back down to about 80 cents now. And you can see at the bottom here, this is the discount, which again has obviously varied enormously. So I do think it's a very interesting trust to watch if you are interested in short-term trading, which is not really what investment trusts are about, but they can be used for that. This is perhaps a trust to think about, although the dealing spread is not the keenest, and it's in US dollars, so you have a currency risk as well. So anyway, an interesting one, and I dare say we'll just see continuing volatility here. So I'll move on to healthcare, and those two investment trusts with Bellevue Healthcare and Polar Capital Global Healthcare, which both fell by more than 6% over the month. Those two trusts don't have that much in common apart from the sector. Their holdings are not particularly similar. So I did think this was probably a sector-wide decline. And having looked into it, I think that's the case. So Again, this is a year-to-date chart. It shows the US healthcare sector, and it's really the US which is relevant here. The US healthcare sector is the blue line against the yellow line here, which is the broader market, the S&P 500. And you can see the degree of underperformance here is quite considerable in 2024 to date. So the healthcare sector is up. I mean, it's not been a disaster, but it's up by 10% compared to 20% for the market. So it's only delivered half that return. And clearly the market has had a lot of that momentum from tech companies. And so I think probably you will find many sectors have underperformed the S&P in the near term. But that's why these figures at the bottom are interesting as well. Because if we look at the longer term figures here, the 1 year, 3 year, and 5 year returns, again, they all show considerable underperformance by healthcare. Over 3 years, it's really quite dramatic, only 7% from the sector compared to 31% from the S&P 500. So this is not a new phenomenon that healthcare has underperformed. And I find this quite difficult to reconcile with the extremely positive narrative that comes with this sector and from the managers who all talk about these tremendous tailwinds of demographics, which I think they're undeniable. We have an aging population in Western economies, and more healthcare is demanded. There's a lot of great innovation in the healthcare sector now. The FDA is approving more drugs than ever. Really, the narrative behind it all is very strong. It's just not matched by performance. And in part, that the resolution of that comes out in the valuations, which are low in this sector. So again, I mean, I think it's an interesting question for you to wrestle with, whether this underperformance makes it a great bargain. And again, we'll see a reversal here, and we'll see healthcare eventually come back into favor, or whether in fact it's a perpetual underperformer in spite of the great story, because we have seen that in the past. So the next question, I think, is, well, given this underperformance, can I maybe pick up some healthcare trusts on a great big discount and put them in my portfolio and be patient with them? And the answer is, well, no, actually, that healthcare trusts are not particularly cheaply rated. I've got the listing here with the discount on the right-hand side. If we look at the major ones, we've got Bellevue on an 8.9 discount, International Biotechnology on 9.5, Polar Capital 5.4, the Biotech Growth Fund on 8, Worldwide Healthcare on 10.2. So those are okay, those discounts, but they're nothing outstanding, and they're narrower, in fact, than the broad investment trust average discount, which is more like 13.8. So I don't think there are particular bargains here to be had at this time. So that doesn't really help with resolving the question I posed. I do think one interesting one here is RTW Biotech Opportunities on a 25 discount, sometimes thought of as being a trust of private investments. It actually has a mix of private and public, and more public at the moment. And I think a 25 discount there is probably quite generous. I'd just like to finish actually with a little bit more about this trust. There's one specific item I noticed that I think is worth talking about. And that is that this trust currently has 2 classes of share, or actually it doesn't. It has 1 class of share, but it has 2 quotes listed on the London Stock Exchange. There's the RTW dollar quote, and there's the RTWG sterling quote, which the trust has decided to dispense with. As you might on the surface think, well, that's quite bad news. Surely for UK private investors in particular, you want to be able to deal in sterling. So removing that is reducing my choice and reducing the availability. I think the exact opposite is true. Actually, I think this is a very good move. And I've been asking the company about this for a while, actually, because in fact, those 2 quotes are for the exact same class of shares. So there's no negative implication here for current shareholders who bought them through the sterling quote. You just transfer straight over to the dollar quote. That's no problem. And actually, with modern stockbroking platforms being able to execute all of the foreign exchange for you completely automatically, cheaply and simply, there's just no need to have this separate sterling quote. And I've been frustrated for quite some time that one of the biggest stockbroking houses, in fact, the biggest, has been forcing people into these sterling quotes rather than allowing them to choose between the sterling quote and the dollar quote. And the reason I don't like that is because the sterling quotes tend to have much wider dealing spreads. In the case of RTW, I checked them on Thursday. The dollar quote had a spread of 3.3%, and the sterling quote a spread of 6.7%. It was actually just more than double. So you were being penalized for taking the sterling quote there, and that seemed wrong to me. So I just don't think they're useful, these quotes anymore. There was a time when they were, because it was more difficult to do the foreign exchange through your broker, but that's not true now. So I think we might see some more of these disappear. I've just listed on the screen there quite a number of other of these secondary kind of dollar-denominated trusts that do have sterling quotes. I don't think they're valuable, so I think we might see a few more of those disappear, which just saves a few pounds for the investment trust, which is good common sense, but it also simplifies it, and I think gives investors the best opportunity to deal on decent terms. Just before I finish, I can just see there's a question about Pantheon Infrastructure, which was on the list of movers. I think this is a well-regarded trust, actually. I haven't written about it for some time, but I know certainly amongst the broking community, it has a very good reputation, and I expect you've written about it as well, James.
Yeah, we have. Yeah, and we like it. So
Yeah.
and it's too cheap. So we go. Cool.
Great, thank you.
Thank you very much indeed, Andrew. I'll go back to my screen again. Yeah, it's a lot of interesting stuff you covered there. But we'll come back to that another time. We better move on. So let's talk to Richard.
Hi, James.
Thank you very much for waiting. We're keen to hear more about Castlenau. I say Castlenau, you say Castlenau. I don't think there's a right way of doing this.
Yeah, you can call it. Yeah, use whatever you like.
Yeah, exactly. But we've got a presentation that you sent through, so I'm going to let you talk for a bit. Just tell us a bit about the fund, please.
Sure. Great. Well, if you get to the first slide, I guess if you Castlenau, just to explain, it was launched by Phoenix Asset Management, who are the investment manager, in October 2021. It's based in Barnes, which is also where Phoenix is, and named after a road here, and it's a Guernsey incorporated investment company. If we go on to the next page, we've got quite a lean team. So if the way to think about it is, there's Phoenix, who's the investment manager, and I think Gary Shannon is pretty well known in the investment trust space as well as the investing space. And at Phoenix, they've got a track record of, I think, over 11% since 1998 annualized. So incredibly strong pedigree from Gary, and he was founder of Castlenau effectively, and him and his analyst and research team provide a huge amount of the knowledge and experience that's going into selecting companies. Then we've also got effectively a team at Castlenau that's focused on enhancing our investments. So if you look at the people I put on the page, we've got Andrew Geary, who was actually the CEO of Lush, who's a serial entrepreneur. Charlotte O'Shea, who spends a lot of time focusing on kind of their user experiences, the customers, innovation. Nathan, he knows a lot about development and technology. And the idea is, along with Mila Rain and Roddy, who have executive teams, we enhance and kind of augment the management teams to drive delivery in our portfolio. Just to explain relationship with Phoenix, as I said, to Phoenix are the investment manager, led by Gary. They're worth pointing out the performance fee here. So there are no management fees on the fund. There to ensure there's alignment. There's a performance fee payable if there's outperformance versus the all share, which is paid in fees, but there's no annual management fee. I think the other interesting thing, just in terms of structurally, is Sir Peter Wood. His investment vehicle is a cornerstone, and we'll come on to talking about partners. And we spend a lot of time nurturing partnerships, and they're quite beneficial to our portfolio companies. But Sir Peter he was a founder of Direct Line and eShort, amongst other things. He still is one of the partners that we'll come on to, but is very involved in the business, and a useful person to have on the register. If we go to the next page. So look, we'll come on to what all the different companies are in the portfolio, but I thought it was useful to kind of set out what we're looking for holistically. So we're looking for companies that have a moat around them, or economic, or actually more general, or IP, something that means that they can't be disintermediated. We look for a material TAM, addressable market, so that we're not looking to make investments in businesses that can't be sizable. We have traditionally and continue to look for digitization opportunities, and by that we mean where the digital offerings probably been underinvested historically. And we've got a lot of skills and a lot of partners who can help improve those offerings. And I'll come on to how we've done that before. I think best in class, we normally look for market leaders or people that are differentiated in the market that they serve. We look for strong cultures and management teams that can lead that. We're not super keen on fundamentally changing management teams. We want to find places where there is a good ingrained culture, but we do look for strong value. Gary Phoenix has always been someone that looks for the right time to invest, and the idea fundamentally is to create a flywheel effect with our investment. So we've got a portfolio at the moment. We'll add to those over time. We'll add the Phoenix experience, the skills we have at Castlenau. We'll utilize the partners we've got, like SP1, Iona Star, that we'll come to. We've got a significant network of people that can help, and the idea is to go from to create the companies into great companies which are cash generative. We look to invest effectively ever long, so we're not looking to have exit horizons in the portfolio. What we want to do is create a portfolio of great companies, get them to be cash generative, and if they don't have a use of capital at the return hurdles that we look for, invest that money into other companies and build the flywheel. If we go to the next slide, there's a lot of detail on here. I thought it was more useful if people look at it after than me reading it out, but you can see here the portfolio as we stand of the 9 companies. It very clearly, the top 2 are almost 83% of GAV and 5% of GAV. Worth noting, Dignity have got listed bonds, Hornby are listed, and Silverwood's listed. So there are kind of some constraints about what we can say. The rest are private. So we do have a mix between the two, and we don't mind whether a business is listed or private. What you will also see though is that we look for a control stake. We most of the ownerships, apart from the Silverwood at the moment, we've got materially over 30%. We aren't passive. We are looking to help steer management teams and drive value there. If you think about what I said around what we're looking for in these businesses, I think each of them, so Dignity, which is the biggest funeral end of life services company that we'll come on to, Hornby, a leader in hobbies, Cambion, the market leader in wedding gift lists, that you'll be able to kind of tick off effectively the characteristics that I talked about before in each of them, whilst noting that they are from quite a diverse set of sectors. So there are some sectors we wouldn't look at, but we are broadly sector agnostic, as long as the characteristics that we look for are covered. If we go to the next slide, again, it's probably an oversimplification, this page, but this is an attempt to explain how we're trying to facilitate the companies becoming great, as we talked about in the flywheel. So we do have pretty strong views on how a company should operate, conceptually and theoretically, and a lot of that comes from the Phoenix team's extensive reading and the Castlenau team's views on the world. So we codified that and put that into frameworks that help the companies that are in the portfolio understand kind of how we think about capital allocation, technology, culture, and I think that's quite helpful for us getting the learnings that we've got across the portfolio. We also strongly believe in best practice sharing. So we're trying to foster a culture across the group. So we have regular forums where we get all the CEOs and CEOs in a room, and that's not to dictate, actually, that's just to foster say, for example, on the CTO side of things, that is to get people to talk about the impact of AI, what they're finding in the market at the moment, and share best practice for the benefit of everybody in the group. We spent quite a lot of time strengthening our boards over the last 12 months in particular, so I'll come on to that in a bit more detail. But we've managed to attract some very senior and kind of experienced talent into the group, which we're pleased about. Capital allocation is a fundamental bedrock of what we do. We're looking to make high levels of returns, so embedding an understanding of capital allocation in all of the companies, and also being involved in those capital allocation decisions is something that is important to us. And going back to, as I said before, the kind of a technology and innovation side of things, so helping the businesses that, like I said, one of the investment thesis is digitalizing businesses that haven't got that limb to their business cases at the moment. We've got a lot of expertise both at Castelnau, but also in the other portfolio companies such as Cambion and Ocular, which we can help deploy to improve the wider portfolio. What I've done on the next few slides, if you go to 9, James, is I won't go through all of this in detail again, but I wanted to call out some of the strategic process we've had in the portfolios, but also, I guess, talk about what the future looks like, because that's kind of more interesting. I'll maybe spend a minute or two more on Dignity than the others, given it's the most material part of the portfolio. But so stabilization of the capital structure, we've got listed bonds. There's been quite a lot out there around what Dignity was intending to do or not do with them. But effectively, there was a trust, £100 million withdrawn from the trust in June, that leaves Dignity in a scenario where we're very comfortable with the covenant position now. The capital structure is effectively stabilized, and that was one of the clouds that led to Dignity struggling in the public market. So that was a material piece of progress this year. Also, the hire of Zilla Bingthorne, that some of you might be aware of. She was CEO of Future Group, FTSE 100. She's also on the board of Trustpilot and M&C Saatchi. So really high quality CEO that joined in June and is already having a material effect. As well as her, we've hired Mike Seary from Time Out to be the CTO, somebody called Zach Sullivan to head funeral plans. So there is a lot of embedding of high quality people into the business, and that's a theme that you'll see running across the next couple of slides. So we've also spent quite a lot of time kind of rationalizing the funeral estate there. So there are some loss-making stores which have been tidied up. There is just a lot of kind of leasehold, freehold that we've tidied up there. So a lot of work, and going to the future, we think this is incredibly exciting. One of the reasons we took it private is the digitization of the business is a huge opportunity. Funeral plan penetration, if we get that right, can totally transform the economics of the business. Owning the whole journey, so engaging with potential customers earlier on, going into legal services, those kind of things are exciting and increasing memorialization. James, I'm conscious of the time you gave me, so I won't flip through all of the other portfolio companies. Happy to take questions on them. But a couple of things I would draw out of as a comment on maybe slide 10, 11, and 12 is that and 12 is there's been a huge embedding of people and senior people with senior experience. So I think that's really important. There's been a lot of tidying up of the companies over the last couple of years, and a fundamental focus on profitability or sales growth in the case of Ocular. So I think we've got leaner, more focused businesses with the right management teams in place, and we're excited about the future. If we go to slide 13, I think this just typifies some of the progress we've seen this year. So again, I won't go through everything on this slide, but if I call out some of the people hires, so Richard Thompson had joined the board of Cambion. He was previously the CEO of RWS Group, so multi-billion pound listed company. Ian Griffiths was the previous CFO of ITV. Zilla, we've already talked about. Neil Sachdev has also got a great CV. So we're getting these kind of heavyweights into the group. We've also done quite a lot of interesting strategic stuff. So Fraser's investment in Hornby during February. Fraser's actually co-invested in Iona Star with us, which is an AI startup. And the interesting thing about that, I guess, is just focusing on Iona Star, but I've talked about the importance of partnerships. So Fraser's we consider one of our partners, somebody that we know well and we do business with. They're partnering with us in Iona Star. Iona Star is a great fund. It's investing in a really interesting space and they've got a great track record in themselves. So we hope to make an economic return from that. On top of that, the technology and the learnings that are in that business, the portfolio companies that they're going to invest in, are going to be things that we can deploy across the rest of the group. That's something that we've done with Ocular. So one of our investments, that is a company that both has delivered economically, we're very excited about, but also is helping the rest of the group. So that you can see this theme of kind of cross-pollination and technology. On slide 14, I suppose we've got to talk about performance. Listening to James and Andrew, you talking before about how viewers of this show probably think about. Look, we're very honest about performance. So from launch to middle of 2023, performance came off, NAV reduced. There was a ton of hard work going on behind the scenes, and I think a lot of the work that has been going on has started to be realised, and there's more tangible outputs of that. The big jump over the summer was to do with effectively the capital structure being resolved at Dignity, and it was if you want to look at our quarterly, there's more explanation around that how that happens, but there was effectively a revaluation of Dignity due to the fact that we'd released that excess surplus cash. And look, we're back to broadly where we started. I think that is not where we want to be, and I think the bedrock of where we think we can get to now being laid, and actually a lot of the heavy lifting has been done. Now we're into execution mode of getting the future delivered in the portfolio companies that we've got and looking for new opportunities. So slide 15, I guess the reasons to be optimistic is the bench of talent that we've talked about at Castlenau and we've entered into the wider group. The progress being made connecting the companies as well. So the interconnectivity has worked well. The Dignity transformation, I've talked about the hires, really pleased about Zilla, really pleased about capital structure. We've got a focus on digitalization. There are a couple of bolt-on pieces of M&A we might be looking at to progress the strategy, but all of those things we really feel are going in the right direction. And I also think, to talk about partners again, the evidence, so not just talking, but we've got this partnership network, the fact that we're co-investing, the fact that we're finding these businesses and driving results is exciting. So it's reasons to be optimistic of a tangible delivery of a lot of things that for a couple of years we were talking about. So with that, I hope that wasn't too long, James. I'll hand back to you.
No, great. Thank you very much. Yeah, definitely covered a lot of ground there. There's a question here actually which occurred to me before. Obviously, the way that your fees work, I think you explained this earlier on. You're not taking a base fee, but you are taking a performance fee.
Yep.
So starting October 21. So you haven't earned any money off this yet. Is that still?
It's correct. Yeah, and we've still got a bit of a way to go to get it. So again, we're optimistic that we'll get there, and we're working hard to do it. But yeah, we're philosophically we wanted to make ourselves incredibly aligned to investors, and we are.
Fair enough. Cool. Then within the structure of the companies that you've got here, how do you use debt is it sort of on a company by company basis, or?
So a lot of it, there's quite different scales of business here. So Dignity is a highly profitable business, has its own debt, at actually a very cheap coupon rate. Some of the other businesses are effectively very early stage, so we would provide the loan, any loans that they require to them at an appropriate interest rate. So we are fundamentally, we don't intend to leverage our companies. It's not part of our investment thesis. We're not a private equity house. We'll use it where it's rational to do so, but it's not part of the way that we generate returns.
Is there much cash in the portfolio?
In terms of at Castelnau level or so we run it quite tight is the reality. So we don't look to hold cash back at Castelnau level. We have it fully deployed, and when we've got cash needs, we effectively raise that cash either by issuing some equity, which we've done this year. We've had some additional loans coming in. Like I said, I think we're at a transition period. So Dignity is the largest portfolio company. We're hoping that becomes cash generative next year to us at Castelnau level, and that can start the flywheel effect. And again, Hornby's there is a lot of work going on at Hornby, and that business is transitioning very quickly. But again, it's a pretty mature business in terms of generates a lot of sales and should be generating cash. The other end of the extreme, Ocular and again, we haven't lent debt to that, and we've just done a successful fundraising with Protura, raising 3.25 million over the summer. But that is that's effectively a tech startup business that's valued on ARRs and will never have debt in it for a long period of time. So it's really depends on which company in the portfolio we're looking at.
Cool. I mean, one of the things that's commendable is how well the discount is sort of kept in, really. I mean, there've been periods when you've been at big premiums, but you're still quite close to NAV. Is that loyal shareholder base? Is that the reason for that?
So I think one of the things I'd say our shareholders are very loyal. We don't see, I think a lot the investors that we've had, a lot of them have been investors for a lot of the journey. I think we spend quite a lot of time with our investors explaining what's going on. So we don't see we have a genuine IR program in terms of keeping people up to date with progress. We update the market. We do quarterly reports where we're kind of warts and all. So we do explain what's going on. I think people appreciate our honest approach. I think we take the valuation very seriously as well. So I think our investors have comfort that we're not, we're representing things in an appropriate way, and when we do put downs to valuations in regularly as well as up. So I think there's comfort that our NAV is appropriate. And I think fundamentally, if we're on Dignity, is a lot of the value in fundamentally because of the size of it in the portfolio. And I think the story is just incredibly compelling there. I didn't want to do the whole presentation on Dignity because this is an introduction, but the size of the opportunity in every element of that business, from the capital structure, sorting out the people, the digitalization, changing the whole industry. So funeral plan penetration in the UK is about 6 to 7%. In France, it's triple that. In the Netherlands, it's about 60%. If we got anywhere near the levels of penetration at funeral plans, so I should explain, funeral plans are effectively where you pay a customer pays an amount of money up front, or they can pay in installments, but it means that they've locked in the price of the funeral in the future, and where they die, that funeral it's effectively paid for. We don't have to worry about people doing that. If that penetration, that would be transformative to the business. And so there are a lot of levers to pull with technology. As I say, it's totally public, but Dignity was technologically quite behind. That digital transformation is taking place, and it can change a sector that is, I think, end of life sector has traditionally been seen as quite in not a modern area of the world. If we modernize it, the opportunity is huge. So to go back to your question, I think a lot of the people that do the work on Castlenau, and particularly Dignities, come to realise the inherent opportunity here. And we're continuing to try and make sure that people do the work and we take them with us.
Great, thank you. In terms of the shape of the portfolio, so you've got 9 companies in there now. Is that enough, or is that too many, or is that about right? What's the?
So I think we're, as I said at the start about the flywheel, I think the reality is we're long-term holders, so you can never say never, but the business model is that we will continue to add effectively. So if a business gets to a position where it's not fundamentally growing anymore, but it's effectively generating cash, and it's not able to reinvest that cash at a level that would generate the returns that we're looking for, we would use that cash, take the cash back to Castelnau and look for investments that do generate that return. So I think the number of investments we have at the moment is manageable for us. We're never going to have a huge list because of the level of impact that we want to help building these companies through. But in a perfect world, we'd look to add selectively over time as the portfolio of companies that we've got mature and kick off cash.
That makes sense. What would be the trigger to sell something?
So in the model that we want to create is that we are evergreen investors, and I think that's fundamental to our proposition, because I think it's also important for attracting companies to join. So I think it would be a challenge company where we didn't think we could help, and it's probably in best developed in somebody else's hands. But it's not. I'm always one for not ruling anything out, but it's not something that's on the cards at the moment. It's not something we'd want to see. I just think it's naive to say you're never going to do something, but it's absolutely long-term capital that we're intending, and that's because also that's the kind of investment decisions we want people to make in the companies as well. We want people to be thinking about investing in what the company could be in 3 to 5 years, not making short-term decisions for the benefit of a value over a couple of months to the detriment of value over 5 to 10 years, because that's how we look at value.
Okay, thank you. Just one thing on Frasers. I mean, is that just a source of capital?
No, not at all. I think from a relationship perspective, we're great admirers of Frasers, what they've achieved, the way that they think about their investments, but also capital allocation, returns on capital, the way they think about the customer. So we see them as a great company, and that is part of the reason that we've got the strategic investment. One of the things that I think Mike, in a Hornby announcement, talked about was he's doing a free consultancy with them to talk to them about their. He committed to talking about the warehousing and the stuff that Frasers are brilliant at. That relationship can benefit Hornby and others in the portfolio. Iona Star is another good example. Frasers has got a ton of data. Iona Star is an AI company, and can see there are natural synergies of that. But no, we're admirers of that business, as well as it being a source of capital to co-investments.
Actually, can you say a little bit more about Iona Star? So what's the ambition with that?
What's the
ambition with the Iona Star?
Yeah, so it's effectively a fund that we have we've put up to 10 million of funding for the life of the funding. Frasers have also put 10 million in, and management have contributed some money. So the first close was a week or so ago. So we're talking to other investors now and looking to raise up to 40. And effectively they are investing in startup data analytics, AI-enabled businesses, globally. The team there are experts in what they do. Jerry, Kevin, Graham, Mike, etc. And they've been doing it for a long time. Highly experienced team. And I think we just see that there's a huge opportunity if you do the work. So their diligence process is they're not. It's not a fad investment. These are people that have been in that area for a long time, looking at a whole host of opportunities and being incredibly selective about it. Equally, where you find a good asset, there could be potentially a lot of value there. One, and like I say, their track record is fantastic from their first fund. And then two, there is a benefit to those companies to the wider group. So, an example of it is the Ocular Boost product. So Ocular isn't an Ion Star, it's a separate company, but they effectively help businesses using AI algorithms to improve their websites and improve their sales. That's actually been effective. Their product has been effective across our portfolio company. So there's the Ocular, which is a great investment anyway, but then there's the tangential benefits to the rest of their portfolio. And I think Iona Stars can be another great test case of that.
Great, thank you very much. We've covered a lot of ground. It all sounds very interesting. We'll follow with interest, and we'll get you back on again and find out how it's going. But good luck with it all.
Great, thanks, James.
And we'll be back next week talking to James Armstrong from Bluefield Solar. So we've got a full lineup all the way through to Christmas, as I said before, and it may change from time to time. I think it was supposed to be European opportunities, but they've had to delay it till January, unfortunately, but you will get to see them. But nevertheless, we've got James on next week, and be good to talk to him then. So thanks for your time this morning, and have a good weekend, and we'll see you next week.